Hello, friends. Today we're taking a look at Adobe, ticker symbol ADBE. They reported not too long ago and they have a big drop of almost 14%. We'll be looking at that. We'll be talking a little bit about what they do. We'll review the earnings report, then we'll jump into the last 10 years of fundamentals, and we'll try to find a fair price to buy this company if you decide to do that. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. Before we continue, let me just give you a full disclosure. After this big drop, I bought Adobe at $500. So I enter at $500. In the last 5 days, as you can see, is down 10%, but it dropped almost 15%. In the last month, is down 3.4%. In the last year, is up almost 43%, even after that big drop. In the last 5 years, it's up 104%. So Adobe analysts believe that it's a buy, and I don't know if this has been updated. The price target, I'm pretty sure this hasn't been updated, but before the big fall, the consensus prices tag was somewhere around $612, which would be a 16% up from current price. Earnings, like I mentioned, it was on March 14. They're trading right now at a 44 times earnings, but if we look at the future PE, we're looking at somewhere around 28 times to 29 times. For those that don't know who Adobe is a company that provides a lot of different services, mostly for, the way that I see it is for documents and visual art, social media. Whenever we're building a lot of these things, I mean, most of us are probably, what will I say? I'm sure that a lot of us are familiar with Acrobat, Photoshop. I used Premiere a lot before I found the thing that I'm using right now. They have stock images. They have a lot of different services. And if you notice, one of the things that actually Adobe, reason why their income also has been growing is because they went from a one-time kind of, you used to buy all of this different animation or different programs, and you just pay a flat fee. You just bought it. They went to a monthly service, which it secures more regular income for a lot of for the company. In the last, talking about income, in the last earnings report in March 14, they beat the normalized EPS at $4.48, but they miss by $2 in EPS to 136, and the revenue was, they also beat in revenue by 36 millions, and the actual revenue was $5.18 billion. I will highly encourage you to jump into the 10K and look at what happened here with the GAAP EPS. I'm not going to mention too much about it because I haven't gone through it yet myself. But as they're looking at the next quarter, the estimates are a little lower than they had before. However, they are expecting more revenue at $5.3 billion in the last 90 days, which will have been leading to the last earnings report. They had 21 revisions up and 8 down. So when we are looking at the future growth of EPS, what let's say the analysts are thinking, they're thinking about that it's gonna grow about $2 per year. So if you think about that, that is, let me just bring this here, 2 divided by let's just say 16. That's about a 12% growth, and then it's gonna supposedly slow down at 11%, and then that will be at 10%. So that's part of the reason why um, uh, a lot of people are a little bit worried about Adobe. I'm not worried about Adobe. I think that Adobe is a great company, and we're going to jump into talking about why I think that is a great company. But before we do that, I would like you, I would like to ask you to please hit the subscribe button. Leave a comment. Let me know what you think about Adobe, whether you own it or not. What is your bull case? What is your bear case? And if you like the content, just help the channel by leaving a like, and yes, subscribe. I'm at 100. I think I'm at 450 something. I would love to get to 1,000 so that I can actually start making money on this. So other than the stock market, of course. So let's jump into the last 10 years. Revenue, as you can see, have been growing pretty steady. I wouldn't pay attention to the TTM because it hasn't changed because it's equal to the 2023. But as you can see, has been growing really nice. I always love to have this graphical representations of the different metrics, because it allows me to see if it's cyclical. As you can see, there's a nice growth in the last 5 years of 13%, and in the last 10 years of um, almost 18%. Those are amazing numbers. Okay. The 5-year growth margins average is 87%, which means for every $100 that they make, it only costs them what will be $23 to make that revenue. So that's pretty good. When it comes to earnings, they had a big jump on 2020, and as you can see, they have been growing pretty nice. After 2020 has kind of stayed flat in earnings, but it's still in the last 5 years a growth of 14%, in the last 10 years of 36%. Profit margin of almost 28% average in the last 5 years. That is above my 25% that I tend to look for. This is great. Free cash flow was growing pretty nice. It had a little bit of a dip on 2023. In the last 5 years, have been growing almost 13%. The last 10 year, a little bit above 20%, with free cash flow margins average of 41%, which is above my 25%. That's great money making machine from my perspective. If you were to buy it, so the average free cash flow yield in the last 5 years is of $2.5%, which means that right now it's at 15 divided by 520. I think it's what it's right now. It's a 2.9 percent free cash flow yield. So that means for every $100, you're about getting 2.9% back on free cash flow. So that's pretty good. Book value has been growing pretty nice at 10% average on whether it's the 5 or the 10. Return on equity at 34%. Very nice. Way above my 15% require. Same thing with return on invested capital at 25.7, and return on asset, it's at 18%, which is really, really, really nice. They don't pay a dividend, so we're going to move forward to the debt. Debt has grown almost 34% in the last year, in the last 5 years, and almost 17% in the last 5 years. But when we look at the long-term debt and we compare it with the free cash flow that they produce, they could pay this off with their free cash flow in less than a year. So that's great. I don't like companies that need at least 5 years to pay that. So this is great. When it comes to share, they have been buying back shares at a rate of about 1% in the last 10 years and 1.38% on the last five. That's really nice. That's not crazy, but it's pretty nice numbers to see. So here's the summary of all the different numbers, the averages, and as you can see, the gross margins, they're very kind of the same. They're very consistent in providing the profit margins and free cash flow margins. So those are great. Well, we're going to be jumping into different valuation systems that I have. Just want to give you a disclaimer. I am not your financial advisor, nor a professional. I do this. I'm just a YouTuber. Do this for educational purposes and for entertainment purposes. I just like to share with you my thoughts on how I see a stock and whether I'm buying or not, but not as a recommendation for you. You should do your due diligence, and I also like to hear from you. So just remind you to let me know what are your thoughts. Where do you think that I'm maybe miscalculating or anything like that, or maybe I'm missing something about Adobe. So let's jump right into my first valuation system, which is the historical multiple valuations, in which I compare. I take an average of the last 5 years in revenue, earnings, free cash flow, book value, sometimes dividends, but they don't pay dividend. And I look at the medium 5-year multiple, and it just kind of gives me an average of what the market has been willing to pay. And if the market will continue to want to pay, we're looking at a fair value of somewhere between $512 to $610. So buying it at $500 like I did, it gives me a nice floor that I can just let it grow. When I look at the revenue base valuation, I learned this from the Patient Investor. He's a YouTuber. I encourage you to check him out. I'm using a 50 PE, which I know is pretty high, but people have been paying 50, an average of 50.7 for this company, and I think they still have some growth. So my fair value today will be $550. Using the discounted earning valuation, growing at a 14%, which is the average of the last 5 years, and paying that 50 PE in 5 years, we see that our fair price is somewhere between 486 to 568. When we use the payback time, growing at a 14%, we're looking at somewhere between 428 to 488. The discounted cash flow gives me a fair value somewhere between 588 to 671. Owner's valuation using a 50 PE, it gives me a fair value somewhere between 591 to 685. So whenever we put everything together, if you like just using the 5-year average, we're looking at a $526 fair value. Because of the way that is growing and because of how it continues to grow every year, I'm more leaning to find as a fair value the trailing 12 month. So if you want to be conservative, that will be close to $600, which will make it, if you want to put a 15% margin of safety, that will be a buy of somewhere around $506. And that's part of the reason why I bought at 500. Now, if you don't like the payback time, so that will make it a about a $616 of fair value, which is close to what the what's it called, the analysts are thinking. And with a 15% margin of safety, that will give you a buy at 524, which it will be about what they're selling right now. So I hope that you really enjoy. If you would like a copy of this valuation sheet, you can find it at Buy Me a Coffee. Please leave a comment down there, subscribe, and I hope to see you in the next video.